Welcome to Talk Tickers. Today, we're breaking down the Q3 2025 earnings for AKA Brands, ticker AKA. Now, this was a quarter where they missed on their key numbers and the stock took an initial hit. But then, something pretty interesting happened. So let's dive right in. On the surface, this looked like a clear miss on both revenue and earnings. But the market's reaction, a sharp drop followed by a complete V-shaped recovery, tells you there's a much more complicated story going on here. Investors clearly saw something beyond just the headline numbers. Here's how we're going to break it down. We'll start with the headline numbers for the quarter. Then we'll dig into the story behind those numbers, see what management's game plan is, and check out how the market reacted to all of it. And finally, we'll wrap it up with our take on what this all means for the stock going forward. All right, let's get right to it. The scorecard. How did AKA Brands actually stack up against what Wall Street was expecting this quarter? First up, the bottom line. The company reported an adjusted loss of 46 cents per share. Now, that was just 2 cents worse than the consensus. So a small miss, but a miss nonetheless. And the top line was a bit soft too. Revenue landed at $147.1 million, which was about $6 million shy of estimates. On top of that, sales actually shrank by almost 2% compared to this same time last year. But here's where the story gets really interesting, and this is a big one. Even with lower sales, their gross margin expanded to 59.1%. That 110 basis point jump you're looking at is huge. It shows that for every single dollar of sales they did make, they were actually more profitable. This was thanks to two things: less discounting and more sales coming from their new high-margin physical stores. So that really is the puzzle, right? How can sales miss while margins are getting stronger? Well, according to management, this was all part of the plan. It was a self-inflicted disruption, but one that was done for a very strategic reason. The CEO himself called them short-term pains. See, they're in the middle of a big strategic shift to diversify their supply chain, trying to become less dependent on China. So the argument here is that this isn't a demand problem at all. It was just a temporary logistics hiccup. And this chart tells that story perfectly. Just look at these numbers. Active customers? Up. Total orders? Up more than 2%. The demand was clearly there. The real issue was the average order value, which dropped almost 4%. What that tells us is people were showing up, ready to buy, but they couldn't find the best sellers or the new items they wanted because of those supply issues. Okay, so given that whole Q3 disruption, management had to come out and lay out their playbook. They reset expectations for the year and made it clear what they're focusing on now. And here's what that reset looks like: a guidance cut for the full year. You can see they lowered their sales outlook by about $10 million at the midpoint, and they also trimmed their profitability forecast. They pointed right back to those Q3 issues and the impact of tariffs as the reasons why. But management was really quick to pivot to the positives. They hammered home 4 key wins. First, they refinanced their debt, which is a big deal. It gives them breathing room until 2028. Second, the rollout of their very profitable Princess Polly stores is really gaining momentum. And third, and this is probably the most important thing for the near term, they said the inventory problems are fixed and sales in the fourth quarter are already trending positive. So you've got this very mixed bag, right? A missed quarter, but a compelling turnaround story. So how on earth did the market digest all of this? Well, at first, the reaction was exactly what you'd expect. After a miss and a guidance cut, the stock dropped over 6% in after-hours trading. But then, look what happened next. By the end of the very next trading day, it had clawed back every single penny of those losses. This price action tells you everything. The market heard that temporary disruption story and, after sleeping on it, decided they believed it. Okay, so with all that context, what's our take on AKA from here on out? This is really the billion-dollar question, isn't it? Was the market right to just forgive that Q3 miss so quickly? Was this inventory problem truly a one-time thing, or is it a red flag for bigger execution problems down the road? You've basically got two camps here. The bull case is simple. The margin improvements are legit, the balance sheet is much safer now, the physical stores are a home run, and that inventory mess is already in the rearview mirror. The bears, on the other hand, are going to point to the weak sales, the guidance cut, that falling order value, and just the tough, choppy environment for retail in general. So, for us, this all shakes out to a market perform reading. We see the bull and bear cases as being pretty evenly balanced right now. The debt refinancing and those stronger margins, that creates a nice floor for the stock. But we need to see them deliver a clean quarter of actual sales growth before we can get any more bullish. We're in show me mode. So how might you play this view? Well, one idea is what's called a pair trade. Here's how it works. You would go long, aka, meaning you're betting its stock will go up, while at the same time shorting the XRT, which is an ETF that tracks the entire retail sector. The whole point here is to bet that AK's specific improvements, like its margins and new stores, will help it outperform the rest of the retail industry, which, let's be honest, is facing a pretty tough environment. You're basically betting on this company, not the whole sector. And finally, before we wrap this up, just a very important final point. Please remember, nothing in this analysis is financial advice. This is for informational and educational purposes only. Thanks so much for joining us.